Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to the important events on the horizon. Let's start with what moved markets this past week. The big story was the continued resilience of the American economy, with fresh data on jobs, inflation, and markets all painting a broadly constructive picture. First, the labor market. New unemployment claims dropped to 213,000 this past week, coming in better than expected and continuing a recent trend of genuine strength in the job market. The number of people continuing to collect benefits also declined, albeit at still elevated levels. This tells us that businesses are holding on to employees even as the global environment remains uncertain. A healthy job market is the engine that keeps consumer spending running, and consumer spending is what drives roughly 2/3 of the US economy. For our portfolios, this kind of labor market stability means companies can keep generating solid revenues and earnings, which supports equity performances across sectors. On the inflation front, consumer prices rose 2.4% over the past year in February, holding steady from January and landing right where economists had expected it. This is meaningful progress from the much higher readings we saw in recent years, and it reflects a gradual return to more normal price conditions. While energy prices can still be unpredictable from month to month, the broader trend is encouraging. When inflation stabilizes, the Federal Reserve gains more flexibility in how it manages its interest rates. This creates a more predictable environment for both stocks and bonds, and it's a positive development for investors seeking clarity on the path ahead. Markets did experience some turbulence this past week, to put it mildly, with the S&P 500 dropping roughly 1.3% as energy prices climbed and investors paused to reassess the macro outlook. While that kind of week can feel unsettling, history offers as an important perspective. Markets have consistently recovered from geopolitical-driven pullbacks, often rewarding investors who stayed the course. We view these episodes as reasons to not for concern, but as moments where disciplined investors can selectively add to positions in high-quality companies at more attractive prices. Our focus remains on businesses with strong fundamentals that can weather uncertainty and emerge stronger on the other side. Now let's look at what drove our performance over the past week and why we remain confident in our positioning. Shell was our top performer this past week, gaining just over 6% as global oil and natural gas markets found renewed strength. Shell's business spans everything from oil production to liquefied natural gas trading to fuel distribution, and that sort of diversification paid off as commodity prices stayed well supported. What makes Shell particularly attractive is that even after this week's gain, it still trades at under 15 times earnings, well below many of the global peers, and it continues returning cash to shareholders through dividends and buybacks. It's the kind of company that benefits when energy markets are strong, but is built to hold up when conditions get tougher, which is exactly the balance we look for. To no surprise, the energy sector was our strongest sector this past week, with all four of our major holdings posting solid gains. Shell led the way, followed by Chevron, ConocoPhillips, and ExxonMobil, rounding out the group. So what's driving this? It's a combination of stable commodity prices, continued supply discipline from global producers, and growing investor preference for companies that generate real cash and return it to shareholders. These are not speculative bets on oil prices. They're all investments in large, well-capitalized businesses that provide meaningful income and inflation protection within our portfolios. And this week demonstrated exactly why we maintain that exposure. Our value strategy was yet again the week's strongest quant contributor, led by those same energy holdings we just alluded to and our utility position in Next Era Energy. When interest rates stay higher for longer and investors become more selective, value stocks tend to do quite well. With commodity prices holding firm and sentiment continuing to favor cash-generating businesses, our positioning is working exactly as intended, and we remain confident in that allocation moving forward. Now let's look ahead at the events that could shape markets in the coming week. Wednesday brings the US Producer Price Index, our window into what businesses are paying before those costs reach consumers. January's reading came in hotter than expected, with wholesale prices up 0.5% for the month and 2.9% year over year. Services costs drove much of the increase, while goods prices actually fell, thanks in part to a drop in gasoline prices, which of course will not be expected moving forward. The concern is the core prices, which jumped 0.8%, which was well above the 0.3% forecast. This data matters because wholesale inflation often signals where consumer prices are headed in the months ahead. If price pressures at the producer level stay elevated, the Federal Reserve may hold off on rate cuts longer than markets currently expect, which could affect valuations across both stocks and bonds. Also on Wednesday, the Bank of Canada held its overnight rate steady at 2.25%, which was in line with expectations. But the accompanying message carried real weight. The bank flagged uncertainty around US tariff threats, acknowledging that trade disruptions could force policy to move in either direction. Canadian GDP is expected to grow just over 1% this year, with inflation near the 2% target. For investors with Canadian exposure, this confirms that the bank is taking a careful, prudent, and patient approach, prioritizing stability while keeping its options open as the trade environment develops. It's a measured response to a genuine uncertain environment. The third major event on Wednesday is the release of the Federal Reserve's January minutes. These minutes have recently revealed a genuinely divided committee. The Fed recently left its benchmark rate at 3.5 to 3.75% in January. That's following 3 consecutive cuts last year. Markets will be reading these minutes closely for signals on the timing of the Fed's next move. With recent inflation data running hotter than expected, the Fed's tone could weigh on rate-sensitive assets and shape investor positioning heading into spring. Thank you for joining us, and we'll see you next week.